Welcome back everyone to the Audacious Witch channel, where we talk about the magic behind the stock market. A storm is brewing in the American economy, and this time the warning signs are coming from Wall Street. They're coming from Honest, Target, Walmart, Estee Lauder, Nvidia, AMD, Tesla, Block, and Coin. Yes, all the stocks are down big year to date. My best performing stock last year, Tesla, a consumer stock, down 30% year to date. Coinbase, even with a revenue growth over 130% year over year, the stock still got smoked. Brutal. Bitcoin is the ultimate real-time indicator of liquidity. It's now down 10% year to date. For decades, Walmart has been the symbol of American affordability, but today they become a hidden sign of economic doom. What did they say that has everyone on the edge? As you're about to see, the truth is more frightening than you think. Stay tuned to the end of the show to learn how you too can make big money if you just do this one thing. As Walmart profit forecast falls short on slowing growth, and this is something I've been warning about, talking about how inflation is running too hot and that income growth isn't keeping up, and this is causing demand to plunge. Walmart now warning that a storm for the American economy is clearly now on the horizon. John Rainey, the CFO of Walmart, described his guidance as consistent with the past years, but noted there are still uncertainties related to consumer behavior and global economic and geopolitical conditions. I listened to the Honest conference call. The CFO, Dave, Loretta, and Carla hinted the same thing, that Honest is catering the higher income earner now, since most consumers can't afford them. It caused the stock to crash almost 20% during Thursday. This is important to understand. He mentions that there are uncertainties related to their behavior. Now we shouldn't be seeing uncertainties if the economy's experience of soft landing. What we should be seeing is an increase in demand, an increase in foot traffic, increase in order size. Everything should be consistent that the economy is turning around. But what he's suggesting that things for the US consumer are getting worse, something I've been talking about in my shorts, and the evidence now is getting very clear. For the upcoming year, Walmart expects overall net sales growth in the range of 3 to 4%. Now keep in mind, that's not inflation adjusted, so you start to knock inflation off that number and you get something less than 2%. That's not a good sign for Walmart. We can see from Celsius and PepsiCo their revenue growth is negative, which after inflation adjusted, it's even worse. Well, if Walmart is struggling and seeing signs it's going to get worse, just wait till everyone else tells you the state of the consumer. We're going to find out it's far worse than everyone wants to believe. Both PayPal and Block stock tanked after the earnings too. Block actually did the unthinkable, a double miss. Revenue growth is weak. Honest Company in Q4 of 2023 made $1 million. This quarter, they lost $1 million. Same management team. Why? Because the economy was better in the last fiscal year, and we know during the end of the year, consumers were front-running the tariffs. Now we're finding out the reality. Income growth isn't there. The labor market is starting to weaken. All that means is consumer demand is coming down. That for retailers is the worst possible sign. Let's take a look at Consumer Price Index is shown in blue against real retail sales that is shown in red, both on a year-over-year rate of change. Looking back to the late 1990s, and what do we see? That the CPI is rising. At the same time, look what happens with incomes. They start to slow down, and as we move forward to 2006, we see the same trend. Inflation shoots higher. But we know wages didn't keep pace. That had again an immediate impact on real retail sales, as consumers had to pare back their spending to deal with higher prices. Sure enough, that caused real retail sales to decelerate entered a contraction. We headed right into the global financial crisis, and let's look at where we're at now. We've seen nearly 3 years of negative real retail sales, many saying that the end of the year was a turnaround, that demand was going to surge higher. What are we seeing in the data from the manufacturing sector here in the US? Inflation rising. What are we hearing from China that they're potentially devaluing their currency that would cause inflation in the US to go up? How about tariffs? Yes, it's going to have an impact. So we can expect now prices to go up. And what does that mean for real retail sales? They're likely now to head down. That's exactly what Walmart is telling us is coming. CFO Rainey said that the guidance doesn't include the potential impact of tariffs given the unpredictability. Around the taxes, Walmart imports food from Mexico and general merchandise products like microwaves from China. CFO said, we'll work with our suppliers, we'll lean into our private brands to keep prices low, and that the company has operated with tariffs for several years now. What he's telling us here is that consumers are trading down. He knows there's financial stress. The households are having to adjust their budgets, cut their spending, looking to the in-house brands. Walmart is telling us very clearly that things for the American consumer and the American household budget are getting worse fast. Costco, Dollarama, and Walmart has benefited in recent years from consumers prioritizing essentials like groceries. Following years of inflation, the most recent core of the company said it saw growth in the market shares primarily from households earning more than $100,000 a year.
We're seeing higher engagement across income cohorts, with upper income households continuing to account for the majority of share gains.
Now, this is interesting because what the CFO is telling us is low-income consumers cannot afford these increases in rent, energy, and food, and still spend on the discretionary side of the economy. Meanwhile, higher prices are also impacting higher income households, who are now trading down to Walmart in a bigger way. Now, what's notable is they're not going into the stores. What they're doing is they're ordering for pickup or on the app. They're doing everything they can to save a few bucks. There is no rebound of spending. What we're seeing is demand decline from consumer spending into the end of the year to front run the tariffs. He knows general merchandise sales are improving, and demand from holiday season was in line with what the company expected. But CFO said that the consumer is steady. You note that he's not saying that they're improving. And there's a good reason why we're seeing this. Look at where we're at now. Walmart talks about how consumers are steady. It's very clear because income growth is flatline, but we're about to see inflation head higher. The risk is consumers will not be able to afford it. Demand will come down. And for retailers, they're telling us very clearly a storm is on the horizon. Even Walmart reports earnings after the holiday season, which the stock plunged 6%. The company's results just came a few days after the data showed a slump in retail sales, and that indicated an abrupt pullback by consumers after a spending spree in the closing months of 2024, which was very obvious. When we look back, and it's clear that consumers saw tariffs coming, they wanted to buy ahead of that, and now they have all that they want and need. They're starting to pay down their credit cards, which is why block stock revenue growth is so weak. And that comes at a massive sacrifice into retail sales. And this does have an impact on the equity markets. Let's take a look at total incomes, still shown in blue against the NASDAQ 100. And what do we see as we go into the dot-com bubble? As income growth decelerates, well, stocks eventually start to come down. It makes perfect sense. As inflation grips household budgets, they have less money to invest. In some cases, look to sell their investments to make ends meet, and next thing you know, stocks and demand come plunging down. We see the same thing happen going into the global financial crisis. And now look, investors say the market can only go up and it's going to surge higher. Meanwhile, income growth is down, plateauing. It likely to head even lower because if Walmart says demand's going down, this is going back to feed right into the manufacturing sector. There's going to be a lack of new orders. At the same time, we're going to see that flow through the services sector, as we typically do with about a 3-month lag, and consumers are really going to get a sticky shock in the next few months. If these tariffs become a reality, coupled with the insurance crisis in California, coupled with the gas prices, eggs are still $12 a dozen. We're hitting a tipping point, and consumers can only take so much. Other costs are rising, something's gotta give. And that's going to be the discretionary side of the economy. And that means it's going to lead right to more job losses. This is how the house of cards falls. Wall Street is dumping everything. Buy the dip won't work on these stocks anymore until we finally have the big crash. The only company that is holding the S&P together for over a year is Nvidia, down 8% after earnings. When you look at Nvidia chart, there is a sign everywhere showing the top is in. AMD is cheap, Google is cheap, but it's all being sold down anyway. Valuation doesn't matter on the downside either. We are in an extreme fear market, and for the consumer stocks, it's better to wait till the real market crash to buy the dip.
Depends which favorite name we might have hit harder back in the 2008 and 2009 period. In the first instance, I spent a considerable part of our cash reserves too early, looking back, too early in the 2009 panic. The bottom of that was reached early in March in 2009, and that bottom was quite a bit lower than September and October of 2008 when we spent 16 or so billion. Now we were committed to finance Mars for 6.6 billion, and that commitment had been made many months earlier, so we didn't really have much choice in terms of the timing of that. But we did fine on the expenditures we made during that period, but obviously we didn't do as well, remotely as well, as if we'd kept all of the powder dry and then just spent it all at once at the bottom. But we've never really figured out how to do that, and we won't figure out how to do that. So the timing could have been improved dramatically. On the other hand, as late as the late fall of October 2009, when the economy was still in the dumps, really in the dumps, we were able to buy BNSF, which will be an enormous part of our future. So overall, we did reasonably well going through that period, but looking back, the most money would have been made just by buying a bundle of stocks. When we were buying Harley Davidson bonds at 15, looking back, we should have been buying the stock, but that'll always be the case. Overall, we would love the idea is we want to buy big businesses with good management at reasonable prices and then try to build them over time.
And that is how you make the big bucks, by waiting patiently.